Well, good morning, everyone. It's Monday. It's November 18th, and again, the theme of the year, the theme of the week, or the theme of the day is where in the world is this year going? I mean, I can't imagine it's already end of the year. Oh, yeah, yeah. All right, let's talk about this week ahead. The big news this week is the FOMC minutes. This is where the Fed tells us what they're thinking, what they're projecting, how they feel the economy is moving in terms of interest rates. And here's the thing about this particular FOMC minutes. I don't believe the Fed is going to make any movement no matter what they say, and I'll tell you why. The first time they lowered rates, the market rallied. The second time, the market rallied. The bond market rallied. Because remember, when you lower rates, bonds rally. There's an inverse relationship. And then the third time, practically 2 weeks ago, the Fed lowered rates and said we may lower rates again, and the bond market went south. So the Fed, as far as I'm concerned, has very little power at this point to drive the stock market or the bond market. I mean, usually if a Fed says they're lowering rates and they may lower rates again, you would see this type of price action, similar to what you saw in August, not what you saw in late October, early November. This is just not very encouraging. So if the market starts dropping and the Fed says we're going to lower rates, look at what happens. Bonds go down. Bonds go down means rates go up. Fed doesn't have a lot of power right now. Fed can't stop a market bleed right now. That creates vulnerabilities. And that's why this FOMC minutes is going to be a lot less important than it's been in the future, because there's very little impact the Fed can have right now. They've already wasted their bullets. They've wasted their gunpowder. They have no ammunition left right now. If things work out with China and they start raising rates or prevent rates from moving higher, that's a different story. But in terms of Fed lowering rates and saving the day, no. Why? Again, look at this. Lowered rates, bonds go down, rates go up. Fed lowers rates and rates go up. Not good. Not good at all. Very bad. This is very bad. This creates a huge vulnerability for the U.S. stock market. Now, let's talk about the U.S. stock market. Russell 2000, mid-cap, small caps, has not broken out yet. S&P 500, 6-week highs. Dow Jones, 4 weekly highs. The small caps and the mid caps, this is saying we're waiting to see what happens with China. Till we see this sector here break out, you're not going to see strength in the U.S. stock market. Let me prove it to you. This is the overall stock market from a percentage of stocks trading above the 200-day moving average. Not in the S&P, in the overall stock market. Folks, 56% of stocks are trading above the 200-day moving average, which is a lot more representative of this than the SPY. The SPY is just grossly overbought, and it's being driven by literally a handful of stocks, and it's just grossly overbought. And I'm going to tell you, when the SPY pulls back, we're going to see a nice pullback all the way to the 285 area, because the more overbought something gets, the better the pullback in the other direction. So I'm expecting a nice little rubber band. That rubber band is just getting stretched. It's so stretched out. RSI is at 82 right now. 70 is overbought. It's at 82. Meanwhile, small caps or mid caps, they're saying, let's wait and see what happens with China. And I'm going to tell you something, folks. Till this breaks out above the current high, let me show you where this sector made all-time highs. Right here, over a year ago. That's how sensitive small caps are to the overall market. So till we see a breakout, it's going to be a very choppy market, and you're going to have to be very, very picky with the stocks you select. Now, these are the 10 main sectors. I would avoid technology. And if you look further, financial, health, industrial, these are defensive sectors. Notice that consumer discretionary is almost at the last spot and technologies at the first spot. They're usually neck to neck. This is telling us the market is extremely fragmented. Usually you'll have technology and consumer discretionary, because think about it, Amazon. Is Amazon a consumer discretionary stock or is it a technology stock? Microsoft, is it consumer discretionary? Is a Microsoft Surface, is it a discretionary consumer item or is it technology? You see how the line gets crossed? So the fact that consumer discretionary is almost, it's at ninth place, it's one above the lowest place, and technology is in the first place, it's telling us the markets are very fragmented. And when markets are really fragmented, that's when you have to be a real careful stock picker. Because look, again, if 56% of stocks are trading above the 200-day moving average, then 44% of stocks are trading below the 200-day moving average. So if you pick one of those 44 stocks instead of the 56 stocks, you're going to be in a bearish stocks versus a bullish stock. The S&P has over 70% of stocks above the 200-day moving average. But again, it's not representing the entire market because it's market cap weighted, while the smaller stocks have a much equal market cap to each other. So while you're looking at the S&P 500 and you're looking at all the data and these news reports are telling you, hey, the S&P is making 6-week highs. It's all-time highs. It's bullish. It's bullish. No, it's not. It's not even close. It's going to get bullish when the Russell 2000 breaks out above this channel. Till it does, no soup. Now, I want you to look at something right now. Now, folks, as I said earlier, this is a stock picker's market. I mean, this is not a market that you want to trade. You don't want to own indices right now. You want to own stocks that are making 52-week highs, that are trading above the 50-day moving average. You want to make sure you're in a top stock, all right? Now, this is one of the stocks. I wanted to show you this. This is Broadcom. It's one of my top relative strength stocks. And this is from a system called First Strike Portfolio. And what this system does is it looks at 10 major factors to determine if a stock is ready to go higher or not. It looks at momentum, it looks at volatility, it looks at fundamentals, it looks at everything, really everything. And again, this stock just broke out and it's looking to go higher. Now, this is just one of the stocks that First Strike Portfolio is considering right now. And I'm going to be releasing alerts just in about an hour and a half. And this alert will have all data on my highest rated stocks that I'm going to be buying. And this is one of them. Now, these trades move really quickly, and I don't want you to miss out on them. I recommend you sign up and start profiting. Give it a shot. First Strike Portfolio, volatility, fundamentals, relative strength, technical factors, everything you can imagine. And again, in this stock picker's market, when 45% of stocks are bearish, you want to pick the best stocks. And First Strike Portfolio only picks stocks that are in that upper range. So again, you got to check it out. Click the link below, First Strike Portfolio. I'm going to be releasing the new signals in literally less than an hour. The market's going to be opening. You don't want to miss this out. This is a really selective service where I give you the best stocks, the entries, the exits. You don't want to miss this out. And again, Broadcom is one of these stocks. Notice flat top breakout, volatility is not expanding. It's making new highs or close to new highs, and it's about to break out. And again, if you want stocks like this, check out First Strike Portfolio. I'll talk to you guys soon. If you guys are enjoying this, like the video, subscribe to the channel. Oh, by the way, you're going to be seeing these videos on our Facebook page. So if you're on Facebook, go to Facebook Wealth Press and enjoy these videos. I'll talk to you guys soon. Bye.